Okay. Buongiorno a tutti, iniziamo a questo nuovo evento di Julia, questo secondo webinar dell'anno, con un evento che sarà un evento in lingua inglese, nel quale affronteremo tematiche afferenti alla politica dei prezzi di trasferimento. In questo pomeriggio abbiamo scelto di effettuare questa nuova modalità di conferenze insieme a degli altri colleghi anche provenienti dall'estero, proprio per cercare di spingere, possiamo così dire, l'impegno di Julia sempre più in un'ottica di internazionalizzazione e di accostamento con le figure di professionisti esteri, e quindi insomma anche di affrontare quelle tematiche che potrebbero essere utili nell'ottica di un processo di internazionalizzazione delle imprese italiane all'estero, e perché no, insomma anche viceversa, nell'affiancamento di colleghi che seguono anche imprese non residenti che vogliono venire ad investire in Italia. Per questo motivo abbiamo selezionato una tematica che è certamente molto attuale nel mondo fiscale attuale, che è quello della disciplina sui prezzi di trasferimento. In questa breve disamina, insomma, ci saranno insieme a noi altri 3 colleghi che presenteremo poi una volta che inizieremo la conversazione in lingua inglese. Preliminarmente ci sarà in questo momento un saluto da parte del presidente dell'ISE, presidente dell'Unione Nazionale Giovani Autori Commercialisti, e a seguire anche 2 parole di saluto da parte di Daniele Rubini, che interverrà in qualità di delegato del direttivo di Julia, per cui passo in questo momento la parola al presidente dell'ISE se vuole insomma dire qualche parola di accompagnamento a questo evento che ci farebbe molto piacere.
Buongiorno a tutti, grazie Elio. Le parole che io andrò a dire di accompagnamento a questo evento saranno rigorosamente in italiano, per evitare di far perdere ogni tipo di senso a questo importante evento che avete organizzato. Io apprezzo tantissimo quello che Giulia sta facendo e quello che voi avete fatto nell'organizzazione di questo evento. Sembra assurdo, ma il limite che ha il presidente dell'Associazione Nazionale dei Giovani, quello di non poter andare a portare avanti una conferenza in lingua inglese, è un limite che la nostra generazione non può assolutamente sopportare. Quindi l'opportunità di riuscire a fare la nostra professione masticando quella che è la lingua di tutti i mercati più importanti che si trovano in giro nel mondo è qualcosa che non apprezzo. L'opportunità che voi state dando a me con la partecipazione a questo webinar e a tutti quelli che sono collegati di imparare a fare il nostro mestiere con la lingua degli affari, quindi con la lingua inglese, è sicuramente importante. Anzi, io vorrei che questo ciclo di seminari, questa esperienza possa avere maggiore slancio e maggiore efficacia anche per tutti quelli che sono i contatti e i numeri della Giunta Nazionale dell'Unione Giovani. Quindi complimenti a te, complimenti a Natalie, complimenti a Daniele Rubini qui in rappresentanza del CDA di Giulia. Io sono, e non è nessun tipo di esagerazione partenopea, ma sono assolutamente fiero di poter avere il mio nome in una locandina del genere e poter far parte di un progetto così ambizioso come è quello di andare a fare la nostra attività attraverso la lingua regina relativamente al mondo degli affari. Vorrei continuare dicendo che Giulia è nata per questo. Giulia è nata per creare delle relazioni tra il mondo dei professionisti italiani e il mondo dei professionisti europei, tra tutti quelli che sono gli attori del sistema economico europeo e anche mondiale, da qui la missione che hanno organizzato i ragazzi del CDA di Giulia a Singapore. Mi auguro di poter pensare insieme a voi ad un evento del genere anche in presenza, con l'opportunità di fare una giornata che sia dedicata interamente a questo tipo di attività, a questo tipo di politica, perché quello che voi state facendo, oltre a essere un'attività didattica, un'attività di formazione, un'attività di politica fra le più importanti che ha fatto la nostra associazione nell'ultimo periodo. Quindi vi saluto, vi ringrazio e vi ringrazio nuovamente per avermi permesso di parlare in italiano. Grazie e buona giornata.
Grazie a te Matteo. Daniele.
Sì, buon pomeriggio a tutti. Io vi porto saluti a nome di Yui, in quanto la presidente Erika Cresti ha avuto un inconveniente, quindi non è riuscita a partecipare e di conseguenza ha chiesto a me di sostituirla. Io come Matteo faccio i saluti in italiano per non farlo sfigurare ovviamente, perché altrimenti solo uno che faceva i saluti in italiano non era carino. Scherzi a parte, anch'io mi unisco a Matteo. Io vivo Iulia come Elio, come gli altri ragazzi che sono connessi, e devo dire a tutti che stanno e stiamo facendo secondo me un ottimo lavoro. Iulia è nata da poco e oltre a fare attività formativa stiamo lavorando anche per andare a instaurare tutte quelle collaborazioni con soggetti, con interlocutori esteri che possono aiutarci a fare internazionalizzazione. E quindi diciamo che l'evento di oggi è uno dei primi, speriamo di farne altri in lingua, perché come diceva giustamente Matteo, è corretto iniziare anche a uscire un po' dal nostro mondo, di lavorare non solo nei nostri studi, ma iniziare ad operare anche con soggetti che sono al di fuori del nostro territorio. Per quelli magari come me, adesso non dico Matteo, come me, che magari hanno difficoltà a fare questo tipo di attività in lingua, ricordo che a ottobre partirà il secondo ciclo dei corsi di inglese di Iulia, e io me ne prometto stavolta, anche l'altra volta mi ero iscritto, poi alla fine non sono riuscito a seguirlo tutto, mi riprometto di farlo perché mi rendo conto che è un handicap abbastanza grande, magari anche per un vicepresidente di Iulia, avere appunto questo tipo di problematica. Non vi rubo altro tempo e lascio la parola ad Elio per l'inizio dei lavori.
Okay, grazie Daniele. Possiamo da questo momento insomma iniziare con l'evento in lingua inglese in modo da coinvolgere anche i nostri ospiti. So good afternoon everyone, and welcome to the new event of the webinar series of the International Union of Young Accountants. This is the first event of the year we are holding in English. And topic of the day are the recent developments of transfer pricing policies and through a comparative analysis of the regulations in Italy, Germany, Brazil, and in India. Today we are going basically to understand what's the main issue that companies in the process of internalizations are facing. Of course, the main focus is our Italian entities, but of course we are going to discuss with the other speakers that now we are going to introduce also the perspective from other jurisdictions such as Brazil, Germany, and India. Today our speakers will be Natalie Pistoli from Italy, that she's member of the scientific committee Fondazione Centro Studi Unione Nazionale Giovani Dottori Commercialisti, and she will discuss, of course, the Italian side. The second speaker is Marcelo Enrique Barbosa Moura. He's a teaching research associate from the Transfer Pricing Center at the University of Vienna that will focus on certain aspects of the transfer pricing rules in Germany and Brazil. And last but not least, of course, Abhishek Padvalkar, which is a teaching research associate at the University of Vienna in the Transfer Pricing Center. And of course, he will report some news about India and the recent developments of the Indian legislation. So I don't want to steal too much time to our speakers. Every presentation will last around 25 to 30 minutes. And of course, considering the time at disposal, please ask a short question, maybe in the section, in the chat section. I will try to select some questions that we will speak about at the end in the second part of this conference. And so in this moment, I would leave the speech to Natalie, that will start to introduce the recent developments in transfer pricing policies in Italy. Natalie, please. The audio is not going. Okay.
Now it's working. Yeah. Thank you, Elio. Thank you for inviting me. And first of all, buon pomeriggio a tutti. Good afternoon, everyone. And thank you. I'm really glad that you invited me. Thank you, Yuya, and of course, Erika and Daniele. Thank you, Matteo and Unione Nazionale, and thank you also Fondazione and Francesco Puccio also for the organization. I will just start to share the screen and to share my presentation. Okay, as mentioned by Elio, just put it in presentation mode. Okay, I will clearly speak about the transfer pricing regulation in Italy. I don't want to lose time. I'll try to stay on schedule, and then I will just start with the agenda, just saying a few words about what I will cover during my presentation. I will start with a short background, just mentioning the timeline of the transfer pricing regulation. You may know that the Italian transfer pricing regulation dated back to officially to 2010, and recently we had a few amendments, a few relevant amendments to the regulation. Just we will go through them during the presentation. I will then move to the actually the most relevant part of transfer pricing regulation in Italy, which is transfer pricing documentation, and how the rules have changed lately, and we will touch the master file structure and the local file, and as well the documentation required for low value added services. I will just trying to see on schedule again. I will touch also the latest regulation about the latest instructions by the Italian tax authority about the arm's length range, and just a few words regarding APAs and advanced tax arrangements, because also on that point of view we had a few amendments recently. Then just to start, just to give you a background of our regulation. You may know that transfer pricing regulation at the OECD level dates back to actually to the 60s, 70s, but actually the main relevant regulation and instructions arrived in 2010 with the update of the transfer pricing guidelines at the OECD level, as a result of which the Italian government and the Italian tax law implemented the first official regulation for transfer pricing documentation, including the penalty, so-called penalty protection regime, which consists of disapplication of administrative penalties in case of transfer pricing audit by the tax authorities. Just to move forward, later on we had BEPS project from the OECD, and as a result of the Action 13 final report published in 2015, the Italian regulation was modified, was amended, in particular to implement the arm's length principle, as before we used to refer to the normal value instead of the arm's length principle. We had another update of the transfer pricing guidelines at the OECD level, just to indeed implement the BEPS reports. Then in 2018, Italy issued the Italian tax authority, actually the through a ministerial decree, it was implemented in Italy officially, and actually the arm's length principle. Thus, we had a guideline for the application of the basic principle of transfer pricing. Then we arrive at 2020, and actually the relevant date is the 23rd of November 2020, when the Italian tax authorities, as a result anyhow of the previous regulation and of the decree of 2018, officially issued a provision including new rules for transfer pricing documentation. Thus, all tax advisors in 2020, the year of COVID, as you all know, had to study these new rules and to implement them, to prepare and to draft the transfer pricing documentation for taxpayers, for multinational entities. In 2021, in November, we had also a new circular letter by the tax authority that explained and provides few details regarding this new regulation and the new transfer pricing documentation. Just recently, the tax authority issued a new circular letter, in particular regarding the arm's length range, thus providing a guidance about the arm's length range and how these should be used when assessing the compliance to the arm's length principle of intercompany transactions. Meanwhile, you know that in January 2022, the OECD issued the new update of the transfer pricing guidelines, let's say implementing the new chapter 10, which is relating to the financial intercompany transactions. Thus, based on this background, let's see what has changed regarding transfer pricing documentation as of 2020. What changed? The fact that all entities established in Italy and involved in intercompany transactions are required to prepare the transfer pricing documentation. The first difference with regard to the previous regulation and with respect to the provision of 2010 is that all entities are now required, including permanent establishment of foreign entities in Italy, and without any difference between holding subsidiaries or permanent establishment entities. Any entity have to prepare the transfer pricing documentation. Actually, it's not compulsory in the preparation of the transfer pricing documentation in Italy, but as mentioned, if well prepared based on the regulation, it offered the chance to the taxpayer to to benefit from the penalty protection in case of tax audits regarding transfer pricing issues. The penalties in case of tax audit range from 90% to 180% of the higher taxes assessed by the tax authority. Thus, having the transfer pricing documentation actually is a good thing, is absolutely advisable. The second main issue as a result of the new regulation regards the documents to be prepared. And from 2020, all entities have to prepare both the local file in Italian and the master file. The master file, which may be prepared in English, which is actually a very good point, as clearly subsidiaries of foreign entities, of foreign groups in Italy taken advantage from the preparation in English or the master file in English, both in case of preparation from the headquarters and also if they have to actually prepare it in Italy, because English is, it's better to share the information in English, and most of the times abroad at the HQ level, the master file is already available in English. Another key point of the new regulation, the new Italian regulation, is the fact that it's allowed to prepare a simplified documentation for small and medium-sized enterprises. Actually, this was the same also in the past, but there was a change in the definition. And the change, as highlighted here in the slide, is that if an entity directly or indirectly controlled or is controlled by another entity which is not qualified as a small medium-sized enterprise, thus if this entity has turnover which is higher than 50 million euro, then we cannot consider it as a small and medium-sized enterprise. Thus, actually, the new definition is a relevant issue, as many subsidiaries in Italy cannot benefit from the simplification for small medium-sized enterprises, as they are controlled by big entities and big corporations. Just another key point on this, electronic signature. All entities preparing the transfer pricing documentation differently from the past must now electronically sign the documents, the attachments as well, and they have also to affix a timestamp. By when? By the date of filing of the annual tax return. This was a big change with respect to the past, and this absolutely requires to timely collect all the documentation requested, to absolutely prepare all the documents and the attachments on time, because of the timestamp that has absolutely to be affixed by the annual tax return filing date, which for let's say for solar entities, the deadline is the end of the 11th month after fiscal year end, let's say the 30th of November every year. Just to start with the master file. I will start with the master file, as it is the document that provides an overview of the group in general, and or the organization of how intercompany transactions works in the group. What's the business of the group? Well, just let's say copying more or less in full the structure of the transfer pricing documentation provided by the OECD guidelines, thus mirroring what is included in the annexes 1 and 2 of chapter 5 of the transfer pricing documentation. The Italian new regulation implements new structure for master file, and then we'll see for local file. As mentioned, the Italian new transfer pricing regulation mirrors the OECD guidelines and implemented the three-tier approach. That's the approach that requires to prepare master file, local file, and country-by-country report for very big corporation having a group turnover over of 750 million. Thus, this is just the background of the new structure of the documents. Starting with the master file, we can see that with respect to the past, we have a simplified structure, but actually very full of contents, and which requires a high effort both from the taxpayer, from the group, and from tax advisors as well. The first two chapters are more qualitative chapters. We have the introduction regarding the organizational structure. We have the description of the group business, including some details regarding the supply chain of the 5 largest products or service offerings of the group. We have to provide details regarding the value chain in the group, thus how the entities works, what's their function in the group, what are the risks they assume. Then we have 2 focus in the master file, which are chapter 3 and chapter 4. The first focus regards the group's intangibles. Thus, differently from the master file previously in force in Italy and previously used, we have to describe in detail the intangibles used in the group for transfer pricing purposes. We have to describe the overall strategy regarding research and development and intangibles. We need to explain the contents and the terms of the agreements, of the arrangements, of any research and development agreements, of any license agreements. We have to describe in detail the transfer pricing policy regarding intangibles and R&D. And we also have to provide details regarding any significant transaction that occur in the group, within the group regarding intangibles. The other focus, as I was mentioning, in regards to intercompany financial activities. Again, a higher effort for the taxpayer, as it is required in this chapter to include details regarding the financing methods which are implemented in the group. We have to describe which are the financing arrangements in the group, within the group, but also with unrelated lenders. We have to provide details about the central financing function, about which entity is involved in central financing, and where is the place of effective management of this entity or entities. And of course, again, explain the transfer pricing policy regarding the financing arrangements. Thus, as you can see, chapter 1 and chapter 2 intend to provide an overview of how the group is structured and how it works, what's the relevant businesses, and then we have the focus regarding intangibles and financial activities. We have the last chapter, chapter 5, which actually is an chapter which includes attachments regarding the annual consolidated financial statement. In the past, it was not required to attach the financial statement. Now it is. And it is also required to attach the existing APAs or any tax ruling which is in place within the group with foreign tax authorities and which are related to transfer pricing and to intercompany transaction. As we saw, as we said, we have to we have to underline a few points and few relevant issues regarding the preparation of the master file. As mentioned, we need to timely collect all the documents and all the information of the financial data required to prepare the master file. And why? Because of the electronic signature and the timestamp, which have absolutely to be affixed by the deadline. This is not always an easy way. I mean, let's imagine a small subsidiary of a multinational group, a small subsidiary in Italy, which have to prepare the master file because actually it is not yet available at the central level, at HQ level. Thus, to be compliant with the regulation, the Italian entity has to prepare the master file. This involves the coordination among all the functions within the company and the departments at which are located at the foreign premises, that's both at HQ level or in other foreign affiliates and other entities of the group. Because of course the Italian entities does not have the chance to does not have all the information and the data available. Thus you need absolutely to coordinate, to require all the information on time to be able to prepare properly the document. Another big effort regards the intangibles and the financial activities. Also in the past, at least with regard to intangibles, we were required to provide an overview, to describe the intangible use, to provide a few details regarding the transfer pricing policy. However, now it is required a much higher level of detail. We have to provide a general overview of all the group's intangibles. Just imagine again the Italian subsidiary, small subsidiary that has to require and to receive all the information regarding intangible used in the group. We have to detail to provide details regarding the DEMP functions, the management of research and development activities, about the strategy. And then we have also to provide details about the relevant transactions. Well, the Italian regulation here mention relevant transactions. The OECD guidelines mention significant transactions. Well, this point actually is not clear to date. I mean, what are relevant transactions? I mean, relevant transactions regarding intangible for the group overall, or only the one where the Italian entity is involved, relevant in terms of amount, relevant in terms of entities involved. What's relevant? Thus, again, there's a coordination work and an analysis that has to be really detailed, and that requires a lot of effort from the taxpayer. The same applies to financial activities. We have to provide details regarding the financing methods, including occurring in the group, regarding the transfer pricing policies, all economic conditions, including any arrangements with unrelated lenders. Thus, if there's a relevant loan with a third party, with the bank, we have to mention it. We have to mention who is providing finance to the subsidiaries in the group, and we have also to explain and to provide details regarding their own place of effective management. And thus, which is the entity, which are the reporting people providing financing functions within the group. Place of effective management, it's clear that it pops in our mind permanent establishment and the issue of permanent establishment. The risk of permanent establishment that you may know is high, and I mean, we have to consider it also when preparing the transfer pricing documentation. And again, this is a good point regarding drafting documentation, as while drafting it, we could, I mean, the taxpayer and the group could realize that there are some other issues involving international taxation that should be considered. For example, indeed, the risk of permanent establishment, and if it's necessary to change something in transfer pricing, or in general in the group, and how the entities are working, and how the activities of the group, how the business of the group is organized. Just to move forward to the local file, I will just spend a few words regarding the structure, as the new structure is actually quite similar with respect to the past. Again, we have the first chapter, which is more descriptive, which provides details regarding the general overview of the entity, the operational structure, the business, and the strategy used. Then we have the second chapter, which is the relevant one in the local file, which regards the intercompany transactions. Thus, we have to describe in detail the transaction and to provide any kind of information and details regarding the transactions, the method applied to assess the transfer pricing. We have to provide details regarding the strategy used for comparability purposes, and the entities involved, the amounts, any kind of details regarding the transaction. Then we have the third chapter and the fourth chapter, which actually are, let's say, more attachments. We have to provide the financial accounts of the entity. Again, in the past, this was not compulsory, was not required. Now we have to attach also the financial statements, including the auditor's report, if available, if provided. And the auditor's report is required also for the master file, when we have to attach the consolidated financial statement. Then we have to provide details and allocation schedules regarding the transactions, actually the methodology applied, and the reconciliation schedules with of the margins and of the results of the transfer prices applied with respect to each transaction, and reconciliation with the financial statements of the accounts of the company. To conclude this part, just let me add that we also have to attach copy of all intercompany agreements. This was also in the past, but now it is required to attach all the agreements and amendments, and also copy of existing unilateral, bilateral, multilateral APAs and tax ruling. Also, if in any of these arrangements the local entity is not is not a party, but which are related to the transactions described in the documentation. Thus, as you can see, also with regards to the local file, we have to keep in mind that the coordination among all the entities, among all the departments and the functions of the entity and at HQ level is absolutely necessary. We have many details to provide to prepare the document, the local file, and we have also to face sometimes some confidentiality issues. Actually, just imagine the Italian entity that has to provide copy of an APA with a foreign entity. Thus an APA that for which the Italian entity is not a part, but actually that involves any of the transactions described in the local file. Well, as you may know, the APAs, the advanced pricing arrangements includes most of the time some confidentiality clauses, some information that the group does not want to clearly to share with anyone. They are shared only for the purpose of the agreement and only with the tax authorities involved. If the Italian entity has to prepare the local file and to attach these kind of documents, well, that's clear that the burden on the Italian taxpayer and the effort that is required is really high. Just a few other examples regarding the management structure. It is not enough just to attach or to show the organizational structure of the entity and to highlight which are the main departments in the entity. We have to describe in detail also which are the reports of the local management and where they are located, where the principal office are located. Regarding intercompany transactions, we had let's say a news. I mean, the new regulation implemented a threshold regarding intercompany transactions that have to be documented. They have to be described in detail, the transactions that exceeds 5% of the aggregate value of income components, let's say positive and negative. Thus, we have to describe the transactions that have a material amount. We have also the chance, this was new with respect to the past, we have the chance to decide which transactions, which intercompany transactions described in the local file, the so-called partial documentation. Thus, the taxpayer can decide which are the transactions that, let's say, are more risky from his point of view and for the group. And he may decide to describe only those one and leave out of the local file the others, any other residual or not relevant transactions. That's clear that then the penalty protection, that's this application of the penalties in case of audit would cover only these transactions that are that have been documented. Well, actually, this point is kind of tricky because taxpayer has to decide if leave out transactions which may be of a residual amount, which may be not relevant, but as a result of a tax audit, this specific transaction can be audited by the tax authorities, just because the auditors think that that transaction is actually relevant, just because the amount may be relevant in their point of view. Thus, you have to decide which are the pros and cons of leaving out some transactions. Thus, again, it's a coordination work. It's an issue of an issue that taxpayers shall consider and should value absolutely with attention. Just few words.
Yes, so we can after
move on.
Yeah.
Just few words regarding the simplified approach for low value adding services. The new regulation implemented officially the simplified approach as provided in the transfer pricing guidelines and OECD guidelines, and provides that if the taxpayer wants to apply the simplified approach, thus the 5% markup to be applied to the total cost in case of low value adding services, he has to prepare a specific documentation. Actually, it's just a part of the local file, which in case of low value adding services, we have to prepare and to describe. Thus, instead of describing the transaction as any other transaction, we have to follow the structure in 4 sections. That's describing the services, the allocation keys, the agreements, and providing schedules regarding the evaluation of transactions and the calculation. I will just move forward very quickly. As I was mentioning at the beginning, we just lately, the tax authority issued a new circular letter regarding the application of the arm's length range and how these should be considered when assessing, when valuing the intercompany transactions. Actually, the new Italian circular letter mirrors the OECD guidelines and the paragraph of chapter 3 of the OECD guidelines regarding indeed the arm's length range. I will just skip as maybe we can just explain it better later, also through an example. Just to mention that as in the guidelines, the Italian circular letter mention how the value, how the results of the comparability analysis performed are reliable, how much they are reliable. If all the transactions of the comparables identified have the same degree of reliability or not. And in these 2 cases, how it has to be considered the value, the arm's length value to assess the compliance to the arm's length principle. I will just move forward. We can come back later on this, as it is actually something that it is shared also with the other speakers, and I think we will explain it later if you agree.
Yeah.
Just few words. I don't know, Elio, actually, if we are on schedule or...
Yes, maybe we can, in case we speak, yes, we can, in case we speak about this later, because otherwise I'm afraid that we don't have enough time to to improve
Yeah,
all the relations.
sure. Just I will leave it. Actually, we can come back later. Just regarding the arrangements. Thank you very much. Excuse myself if I'm not. Not on schedule, and I will leave the floor to the other speakers. Thank you.
Yeah, thank you, Natalie. This was absolutely a good presentation in which we have seen how the Italian background about the TP policy has absolutely changed over the last couple of years. As Natalie said, that there have been a couple of legislative amendments starting from the decree of May 2018 that really started the process of aligning of the Italian regulation with the transfer pricing policy of the OECD. Of course, on the other side, if I can say, despite Italy is really going towards an alignment with the OECD, at least in terms of compliance, on the other side, and this is also based on my professional experience, increase a lot the tax burdens. Because you can absolutely believe me, and now I'm also speaking to non-Italian professionals, that is absolutely not easy to manage all the TP duties to fulfill in time, because as Natalie said, there is electronic stamp, which also required a coordination between the filing of the tax return and the filing, let's say, the conclusion of the TP documentation. If you are just an Italian subsidiary of a multinational group, it's not easy, a lot of time to collect all the relevant information for the purposes of the transfer price of the master file, and it's not said that the parent company has all the information needed to complete the master time on time. So absolutely, from the Italian point of view, we are absolutely going towards the OECD standards, but the OECD standards sometimes are really difficult to manage for the taxpayer. This is something absolutely I also understood on my skin and based on my professional experience. But of course, it will be also interesting to listen which is the opinion of our colleagues from other jurisdiction, the first of which is Marcelo. Marcelo is a Brazilian tax lawyer. As I said, he is a research and teaching associate at the University of Vienna in the Transfer Pricing Center. He is going to speak about two different jurisdictions, which are Brazil on one side, of course, and also Germany. I really look forward to listen to your presentation, because both countries are really interesting for TP policy for different reasons. So Marcelo, you can go ahead and to start with your presentation. Thank you.
Perfect. Thank you, Elio. First of all, thank you. Good afternoon or good evening here in Austria. Already we are in the evening already, in the end of the day. So it's an honor to be here to be speaking with you in this event. And thank you also for Abhishek and Natalie for sharing the panel here for such a good discussion. And the topic is so difficult and comprehensive, yeah, that Natalie couldn't make it in 20 minutes because it's just too comprehensive, and the topic's not that easy. I'll just start sharing my screen, and just a moment. Do you see
the full slide?
You see the full slide, yeah?
Yeah.
Perfect. Yeah, and just a quick overview, as Elio has introduced to you. I'm a Brazilian tax lawyer, but I studied and worked in Germany for some years as in the tax, providing tax services, specifically in transfer price. That's the reason why I'm bringing you some German context here, and also the Brazilian perspective. Now I'm writing the PhD here in Vienna, and also the Austrian environment for transfer pricing has some similarities with the German one. So that allows me, at least from my personal perspective, to navigate through this country. So more or less the main idea here for my agenda for my presentation, just to mix up. Well, for one hand, we have the overview of the German perspective, and on the other hand, we have been hearing some news about the Brazilian TP rules that might change or might not change. I'm just going to bring you at least in this gossip room what has happening in the Brazilian context. So, but that's more in the end of my presentation. So my agenda here, as you can see, I'm gonna deliver you an overview of the documentation in Germany, because that's our main goal here. As we had in the introductory speech, the idea that the audience here also, we are having this event in English to see how Italian companies, which would be the red flags and the difficulties for those Italian companies that wanna go international. They want to be go internationalization projects. So it's more or less the idea for an outbound investments from the Italian perspective, which would be the points to be taken care, or at least to be watch out closely. So then go to the second point, the idea is to bring you the deadlines and the punitive fees if you don't comply with the rules in Germany, which are the areas of attention, which are the more problematic, or at least points of attention. And then I'll just go to the second part, which provides the overview of the Brazilian rules and the potential alignment to the OECD. What does that mean actually? So just jumping now to the idea of Germany as following, it was really nice, interesting, the timeline that Natalie brought us in the first session. Although in Italy, I've noticed that the alignment to the OECD standard is not that old, it's quite new, as a toddler, it's a young kid. In Germany, that's more on the other way around. Germany, since the 1970s, has already been following the idea of the arm's length principle and following closely the idea or to counteract the potential loss of tax subtract in Germany, which means, in normal English, that they were always really careful about international transactions in Germany. And as you know, similar with Italy, somehow Germany is a really strong economy. It's a big country, and then Germany has many multinationals which are headquartered in Germany, but also companies that also German companies that are just subsidiaries of parent foreign companies. So because of that feature, the German tax authorities are really were always since 1970s really following closely any potential profit loss or profit allocation, which was not in line with arm's length principle in general. And also that applies to the documentation. You have the free tier standard OECD documentation that's an outcome of the BEPS project from 2015. But just before that, although in Germany, it wasn't used, that name, but more or less this idea of having an overview of the multinational enterprise and also what has been happening specifically in the country, which is more or less the idea of the local filer, has always been focused by the German legislation, in the sense that the tax authorities were already aware of that, and a taxpayer which would fall within the concept of a related party that had international transactions, which would mean the controlled transactions, they were already subject to a higher degree of compliance within the tax authorities. And that's an important point to be mentioned in general, because the tax authorities or the tax administration in Germany, they are quite acquainted with the arm's length principle. So they are just to some extent well prepared. And because of that, they go really into the details. And as you can expect from the German tax law in general, it is quite specific and it's quite comprehensive, and it goes really detailed. What I put here in this slide is that Germany follows the OECD standard. I would say because of the BEPS project, the main innovation would be the CBCBR, the country-by-country reporting, which was introduced as well in German tax law. But in general, we have this free layer of documentation to be complied by taxpayers, yeah, CBCBR, master file, and local file, yeah. And the legal basis here is this duty to collaborate in procedural principles. Here I put the legal basis. AO is the German fiscal code, yeah, and this paragraph 90 is inserted in the general principles that apply to the tax procedure in general, yeah, and that's the legal base, at least, to the taxpayer to provide this documentation, yeah, and the scope of documentation general, yeah, including therefore master file and local file, to be that we have to take into account all the circumstances that may have importance in TP, and we have the same problem as Natalie said. Okay, what's may have importance? What's important? What's relevant? And that's an interest point which is open, yeah, to discussion by both taxpayers and tax administrations, yeah, because taxpayer might think, okay, that's relevant for me, and tax administration might say, okay, that's not relevant for you, but actually what's relevant is not inside there. I want to see it. So of course there is these arguments, yeah. And here again I put the legal basis. This GALF Z V is the German regulation that provides the details for the documentation specific, yeah. And what's more about this scope of documentation, yeah, it's not only that tax authorities want to know about the legal contracts. I do not want to see only the intercompany agreements or what's the legal base, but also the economic rationale behind it, to understand how do you operate your business. So so we have these both pillars, if you want to call it, to be considered in the scope of documentation. Also, what's the problem here if we have the absence of circumstance, yeah? So if I do not include such circumstance here, which would be already one of the first penalties or problems that we might have here, would be first, we have a rebuttable presumption of higher domestic income, which means I'm going to consider that the tax revenue that you have in inland, yeah, in Germany is higher, and the burden of proof is now on you, taxpayers, not on me, tax authorities, because you did not provide me with all the circumstances that are important in the transfer pricing. Also, one of the other bad consequence for the taxpayer, if you can call it, would be that price ranges. Yeah, Natalie was speaking about price ranges, and it's gonna come up also with an interesting example from the Italian perspective later. But here would be the case that the German tax authorities would say, okay, I have several price ranges here. I'm just choose the one that's most advantageous for me as tax authorities and not for you, taxpayer. So that's a possibility that tax authorities might have if you fail to provide all those circumstances, yeah? Just quick word about the CBCBR, yeah, it follows the OECD recommendation. Here we have the legal base in the German fiscal code, and in general, yeah, we have to provide, yes, M&E has to provide the ID of income tax and employees and assets of M&E, the idea to give an overview of what's happening in the group in general, and also overview of the constituent entities. So which are the entities that play around here in our global operations, and any other additional information that's considered necessary or useful. It's really open and not so certain, yeah. Although the German legislation follows also the OECD standard and provides the annex and the Excel sheet, so to say the XML file that you have to fill it up and submit to the German tax authorities. So going further, yeah, specifically to the German circumstances, yeah, for master and local files. So in general, master file would be for anyone who is part of an M&E with revenues which are above 100 million euros. Here's the legal basis again. You can, for information. And the idea is more or less, as Natalia has comprehensively taught us, is to provide us an overview of the key business, the intangibles, the financials, the taxation activities of the M&E. So more or less the question should be answered here throughout the master file to understand, okay, how in general your company, your M&E works, what's the organization structure, what's the global supply chain, the value chain that plays around in your whole operation, what's your functional analysis here. And then we have the local file, as the name says, we want to have a deeper look on what's what we are doing here in Germany, yeah, taking the German perspective. So the idea is to understand which are the business relations that the German taxpayer has with its related parties abroad. And then we go to the factual documentation. Yeah, I have to provide the factual background, the economic and legal basis supporting the arm's length of the transaction, the price. Here you really have to justify and kind of show the concrete examples of your transfer price policy that you have mentioned in the master file. In the master file, you provide more a high level idea, and then the local file you go really straight to the facts, saying, okay, in my case, I had those and those transactions, and I'm applying this transfer price policy. These are the ranges, this is the benchmarks. Then yeah, we can put it in that way. And the information also used at price setting. So we have also this idea that German tax authorities might say that we do not accept ex post outcomes, but that's a specific topic for the German context. Yeah, and also you have to provide the transfer pricing method that you applied here. Yeah, so more or less that's the main idea here. The master file, the taxpayer has also to provide the financial statements in general, also provide list of service agreements, R&D that are important for the company, which are the key geographic markets. Is all it comes up to the idea of providing a high level function analysis in the master file, whereas in the local file is more specific here. But my idea is not to go into every detail of the local master file, but more or less to give you an idea of what's important here. Yeah, in general, also for deadlines, yeah, we follow a bit, you can say with Italy, we have similarities somehow. So for the CBCBR, we have to file it within 1 year after fiscal year, and the master file as somehow as I understood, if I understood correctly from Natalie, is that upon request of the tax authorities, then you have 60 days. Yeah, so we do not have this idea that master files have already to be submitted automatically by the taxpayer. That applies also for the local file. So at least here in Germany, we have 60 days, which is 3 times more than the 20 days of Italy. So we have a bit more time to do that. And we have the exceptional case, that I put here, the 30 days for extraordinary transactions. And what are those extraordinary transactions? So are such kind of transactions that the German tax legislation provides that they are important, and then I'll just provide a minor amount of time for you to provide documentation. So an example for that would be asset transfers when you're doing some business restructurings that might be an extraordinary transaction. Also the conclusion and amendment of long-term agreements. Then you are really changing. The idea here is you're really changing your business. So that's really not within the regular business of yours, but it's rather extraordinary, as the name says. So then I'm going to pay attention closely to that. Yeah, another example would be the transfer of assets or benefits that are connected with another party within the group. So you have to pay attention if you're having those extraordinary transactions. Yeah, and in general, we have those deadlines, and the penalty fees would be that for the CBCBR, if you fail to do that timely or you made it incomplete, it's not that high. We are speaking here about 10,000 euros, not that big amount of money. But then for the master file and local file, we have some more serious penalty fees. Yeah, so first of all, we have the idea of coercive measures. So the tax authorities, then the business gets serious, so to say, in the sense that they might start enacting coercive measures, and they can also apply delay fines that range from 2,500 euros until 250,000 euros. So now the bill can be a bit expensive, but that's only one part of the story, because it's not only that, and I put here for the local file, we have another consequences, first of all, the reversion of the burden of the proof. Also, the idea that I mentioned in the previous slide, if you have the price ranges, I'll just interpret it in the worst way for you, and then you have to prove the other way around. And I'm also going to consider that you had more I'm going to source more revenue here in Germany, as you've done before, and then you have to rebut that presumption. You have to provide some proof and evidence on that. And also, if you have income adjustment, because of my tax audit or because I've seen that you didn't file your documentation correctly, then I have a fee of 5 to 10% of the income adjustment. So that's quite not easy, because not of the tax that you're going to pay, but of the income adjustment. So that's really a strong fee. The idea for you to do not feel comfortable going that down the road within that idea. And also the idea is that this fee, also for tax purpose non-deductible. You cannot put it in your P&L statement. And also I can also charge you 5,000 euros if there is no income adjustment, only because you did not comply with your documentation requirements. And also, if you make it lately, I can also fine you per day, 100 euros a day, and it might go up until 1 million euros. So if you sum up everything, the package or the tools that tax administration have to at least make you think twice before not complying with the documentation requirements in Germany is quite convincing, I would say. And then if you think about the areas of attention in the German tax transfer pricing in general policy, first of all, as you have heard, I think everyone has heard of it, the financial transactions in Germany, although we have the chapter 10 since February 2020, which was now included in the latest version of the guidelines. The German tax authorities and also the German fiscal court still their case law for choosing the method or choosing the tested party and going to the functional analysis is a bit bumpy, I would say. It should not say that's confusing and mind-boggling. But that's what I put it here. So the choose of method is until now not so clear. We had last year in May some interesting decisions from the German BFH, which is the German Fiscal Court, saying that all the functional analysis has to be considered and dismissed the idea that the tax authority has a bit discretionarily chosen a specific method without having regard to the functional analysis. So that might be welcoming, but this case is still pending to be further analyzed. And because it came back to the first instance in order that the tax court of first instance really sees which would be the most appropriate method to be applied here. So in this case, also in a series of cases, there was this argument of German tax authorities that did not accept ex post database studies. One of the arguments that's quite interesting said, okay, I cannot understand the algorithm or the formula that Moody's or the credit rating agencies used here, so I cannot apply it because I don't understand it. So that's a point to be kept in mind, that financial transactions in the German context are still controversial, I would say. And as I previously mentioned in the slides before, if you have transfer of functions, that's always a big deal. German tax authorities will always look at it closely to understand, okay, which kind of functions and risks have you taken out of Germany and sent to another entity abroad, so that might trigger some taxation. So if you have any of those business restructurings, that's always a point, a red flag to be considered within your documentation. So that means, the bottom line here is that you have to document and really present the case for the tax authorities, saying, okay, I have done this business restructuring because of that, and those were the consequences here. And you have always to provide and see, okay, why did you do that? What's the reason behind it? Why are you transferring those risks and those functions abroad, for instance. Yeah, and I put here some examples, such as the conversion of a full-fledged distributor to agent or commissionaire, or if you're shutting down a licensed manufacturer, yeah, that might also open the eyes of tax administration. And also substance in general is an issue here. So if you have a related part, a trading company in a low tax jurisdiction, you have to prove, or at least show that you have engagement in business with third parties and on a standalone basis. Just to say that you have not put your trading company in a low tax jurisdiction just to benefit from lower taxation, and you just receive support from the German company. So there's no substance in that structure. So that's more or less the idea for the German documentation and for the German transfer pricing policy framework. Yeah, so that'll be it for Germany. And now I'll just quickly jump to the Brazilian context. Yeah, as you are already acquainted with, you know that Brazil follows, until now has followed a really specific way of addressing transfer pricing rules. The transfer price rules in Brazil are somehow young. Yeah, they were enacted in 1996, and they were naturally based then on the 1995 guidelines, where the main proxy that was driving the Brazilian legislator was simplicity and easy of administration. So that came to the outcome that we have fixed margins. Yeah, so you apply just those fixed margins for control transaction. I'm just making it just a general broad overview. Of course, we have some peculiarities, but more or less the idea here is that the Brazilian transfer pricing rules provide fixed margins that vary according to the type of the product that you're using. So you can apply either 20%, 30%, or 40% as margin to be considered and accepted by the Brazilian tax authorities. Yeah, the commodity transactions. Yeah, as you know, Brazil is a really commodity exporter economy. So we have this methodology in which if you just show up that you traded those commodities according to the value of the stock exchange in which they are traded, they might be accepted. They should be accepted. Yeah. So that's really a simple system. So we do not have this idea of comparability analysis, making a function analysis. Arm's length principle in general is not an issue so far in the Brazilian framework. Yeah, as I say here, yeah, we do not have to perform a function assets and risk analysis. Yeah, and more or less intangibles also is not a big deal. Now, here we do not have to do, as now we have to do in Italy, as Natalie said, to provide a list of relevant, important intangibles for the Brazilian operations. So we just have the idea that they might be registered within a public body, the trademark or the patent, and then it is allowed a minimum amount for tax deduction. So the idea here for intangibles is just for tax deduction, and not in general how they create value, or they are important in the bigger picture. Yeah, and for intragroup financing, we have also fixed rates. Yeah, so they follow the rates of the Brazilian bonds plus a spread. Yeah, for loans we have 3.5 and debts 2.5. So these should be quite easy, but is really not attached to what is a market value. Yeah, and documentation, yeah, we just have CBCBR to be filled within by the multinational company in the corporate income tax return, and we do not have the idea of master file and local file. But history is about to change. Yeah, because yeah, since 2018, the OECD together with the Brazilian tax authorities have been carrying out a study. As you might recall, in 2017, Brazil has requested its adhesion, its accession to the OECD. One of the main problems or issues to be considered within that whole process of accession to the OECD is the Brazilian transfer pricing framework. Yeah, so then both OECD and tax Brazilian authorities sat together and started to understand how is actually, let's make a really good picture, take a picture of how the Brazilian transfer pricing framework works, and they came to the conclusion, that's the picture that I put here in this slide, and that's a really an extensive and comprehensive reports about 300 to 400 pages, where it comes to the conclusion that the Brazilian system, although it's called or is argued to be simple, is not that simple, because one, it follows to coordination problems because you apply fixed margins, but in the other countries that follow OECD, arm's length principle in general, you might have double taxation issues because the European company, the European headquarters, for instance, in Italy or in Germany, cannot apply the Brazilian methodology to explain it to its transactions in Germany. So then the German corrects the value that were accepted, so to say, in Brazil, and it follows from that double taxation issues. And also, we have loss of tax revenues because the Brazilian tax framework does not consider the value of intangibles, for instance. So the report speaks about BEPS issues, where according to which Brazil just does not look at the intangibles, and with that you lose some tax revenues that you could consider in your control transactions. But the report does not only say that, it comes to the conclusion, okay, Brazilian transfer price framework has to change, and it has to come to an alignment with the OECD rules, and that's both views, according to the report, of the Brazilian tax authorities as well as from the OECD. And what's the idea here for the way ahead? The idea is to provide some legislation that aligns to the OECD guidelines in general, to the OECD standards, and it might be allowed. The OECD recognize that these legislation would be welcoming, would be interesting if we had also some safe harbor provisions that provide simplicity and easy of administration for tax authorities, but they might comply, should comply with the arm's length principle. The actual status, the current state of art for these projects. The Brazilian Minister for Finance is drafting the legislation. We had an event in April this year, 2 months ago, an event together with Brazilian tax authorities and OECD, and they promised, they said they are currently drafting it and they might present it shortly, but there is no hard deadlines here. It depends on procedure, on legislative procedures, and if you remember, the Brazil political perspective, we are going to have general elections this year. So from the parliament perspective, I'm not quite sure whether this piece of legislation might be brought up or might be voted or passed. I don't know. But the fact is that we do not have a hard deadline to implementation. We have just the willing, the political statements of that. And in general, the Brazilian scholars are skeptical because, as Natalie said in her speech, as Italy, now we are aligning to the OECD standards, but the OECD standards in general, they're comprehensive, they're really specific, and they really burden both taxpayers and tax administrators because they require really a huge amount of information. So there is always some implementation issues, how to go around with that. So more or less, those will be my main points from the German and the Brazilian perspective. And looking forward to a discussion with you for questions, I think not now, just after Abhishek's presentation, so that we can discuss it. Thank you.
Thank you very much, Marcelo, for your interesting presentation, both for Germany and Brazil. Well, as far as understood, in Germany, there is a quite simpler framework for companies rather than Italy. I understand also, for example, that there is, maybe I misunderstood, but there is not a specific threshold for operation to be listed in the local file.
Exactly. So you have to provide, they are really specific. You have to provide your control transactions. As long as they are control transactions, then they have to be within the transfer pricing policy that you are applying in the local file. And this simplicity is not, you can say it's simple, but I would say it's more, you know, well established. Yeah. This idea of master and local file has been going around for really some decades. So at least taxpayers are used to work with this documentation. But in general, for both, yeah, master and local file, we have a really long list, yeah, more or less similar to what Natalie has put on her slide. I didn't put here, yeah, because it's just too comprehensive, but they go also into the details. But from thresholds, I'm not aware of that, whether they make a carve out of it.
Okay, and the same thing about the master file, because I understand that only multinational enterprises with revenues over 100 millions have these obligations. So actually the legislation in Germany is still on the way to align with the OECD standards, we can say, or probably there is also a different, I think, a relationship between the tax administration and taxpayer. There is a different faith, let's say, each other, so which makes also difference with Italy, which, as we discussed also in our previous conversation, there is always this contrast and fight between taxpayer and tax administration that probably also contributed to create this environment of heavy tax burdens, but maybe in Germany there is a quite let's say nicer relationship between both parties, so there is also more trust from the tax administration on the taxpayer, and probably that there was also a decision from the German government not to implement certain provision, like for example the request to present to file a master file that, as we have seen before, is absolutely a huge work for taxpayers. So I also understand that in Germany, the environment is probably a little bit relaxed.
To some extent, yeah, I agree with you. Yeah, normally the tax administrators, they go into the details, but they are open to discuss and to really understand what's going on. Not only a conflict, they do not have the goal, I have to achieve that. They just want to understand and see whether you are complying, whether what you're doing it's in accordance with the legislation. But if you don't have the master file, does not mean that you do not have the local file, and the local file is already quite comprehensive to some extent.
No, yes,
yeah.
Absolutely. About the specific transactions, the same in Italy. The local file is absolutely, most of the work is made on the local file, of course, and the master file is most overall of the company. But yes, probably what I'm understanding from you, which means, for example, in Italy, if we want to do a comparison, is this kind of approach, this kind of discussions between both parties to understand which is the TP policy. In Italy, usually when the tax administration approach the taxpayer is not to understand basically the tax policy, but is to start a tax investigation on overall. It starts little by little, but at the end you finish with to release a document in which you basically are complaining against the taxpayer for a specific transaction. Instead, I understand that not only in Germany but also in other jurisdictions such as Switzerland, for example, there is also this preventive discussion, let's say, between parties, taxpayer and tax administration, to understand which is the TP policy, and in case, of course, they can make any kind of primary adjustment, let's say, limiting to the primary and secondary adjustment. So probably is also this who makes the distinction between Germany and Italy, as far as I understood now. About Brazil, yes, I understand. I was absolutely much more confident before your presentation, but I understand that the road is absolutely not easy. Also, with respect about the safe harbor provisions. I mean, I don't know in the end how much companies or just the tax administration in Brazil will rely on these safe harbor provisions to create a distance between the real OECD compliance and what will be the future, let's say, Brazilian legislation. I understand that there are really a lot of difficulties in the road of full alignment to the OECD standards.
Yeah, yeah, that's correct. Yeah, I mean, the bottom line here, I mean, for my speech, that I think one of the most important things that we have already is that there is political will. Yeah, they want to do that from a political perspective. That's already a major step. But now we have to go through legislation, yeah, draft the legislation, pass it. And for the safe harbor, yeah, and that I have been working, for instance, with Raffaele. We are about to publish a chapter of a book on it that we really focus on safe harbor, yeah, because you always have the question, okay, if you implement safe harbor, something really out of the blue, which is not aligned with arm's length principle, then you might have the problem that you are implementing something which is not arm's length. So what we propose here is that perhaps we might rethink safe harbor, to rethink, for instance, for comparability analysis, for function analysis, you can provide a streamlined process. Yeah, you can somehow make a safe harbor in which you streamline the analysis, but you're still within arm's length, or you are not so far away from arm's length. So that might be an idea that legislators could conceive in Brazil. Also, if you think some margins, I apply some margins, I'm fine with that. Okay, but before doing that, you have to do a function analysis. You have to say whether your entity is within the functional profile of the safe harbor. So my point is there might be some ways to make a good design of safe harbor provisions in order to not be so far away from arm's length.
But do you have a deadline in like Brazil for, I don't know, like to join the OECD, so that you have, say, a time frame within which you need to formulate the guidelines or the regulations, or not really?
Not actually. I think it was last week they have provided, you know, like a pathway for the Brazilian adhesion to the OECD. Of course, there are other issues that go around, not only tax, but normally those processes take from 5 to 7 years. So there is some road to be pursued still.
Yes, and in the middle there will be for sure a presidential election. I don't know if this thing could slow the process.
Yeah, and as presidential, that also changed the parliament, who is in the end responsible for passing the legislation. That might play a role, but yeah, I cannot predict on that, but for sure, yeah, it might have an impact.
Yeah, let's see, absolutely, because it would be very interesting to see how Brazil will approach the OECD standards. So absolutely, because it's a huge country with a huge economic policy. So let's see what the future is going to present. Absolutely. So the last part, the last presentation comes from Abhishek. Abhishek, as well as Marcelo, is a teaching and research associate at the Vienna University. He will present the latest development about the transfer pricing regulations in India, which is another really interesting country. So we know that a lot of companies decided to establish the parent company in India, also be connected to problems to issues of IP, for example. So in Italy, we have a lot of India subsidiaries. So Abhishek, you can start your presentation. I know we don't have really a lot of time, but don't worry, even if we go some minutes after 7, I don't think it's a problem. The audio.
Okay, yeah, there was some problem with that audio. It said I couldn't unmute, so sorry. Yeah. So thank you, Elio, for the invitation, and the International Union of Young Accountants for having me over here and to give a presentation on the Indian aspect of it. And thank you, Natalie and Marcelo, for the wonderful presentation on the Italian, Brazilian, and the German aspect of the transfer pricing regulations. And I'll just quickly share my screen. Just a second. There is some. Yeah, here it is. I hope you can see the full mode now. Yeah, okay. So again, thank you, Elio, for having me over here. And I'll be like very brief as possible, and just try to give a quick glimpse in the Indian transfer pricing landscape. And like India had the transfer pricing regulations since more than 2 decades now. So the transfer pricing rules were, were formed part of the Indian law in 2001. So been more than 21 years now. And India, though it's not an OECD country, but it still follows what is prescribed in the OECD guidelines with respect to transfer pricing. And like even the courts, when it is assessing or when it is, say, having a transfer pricing dispute, in that case, it places heavy reliance also on the OECD guidelines. With respect to the agenda, so this is the brief agenda for today. So first of all, I'll be talking a bit about the TP peculiarities in India. So over here, I'll discuss quickly about the range, multiple year data requirements, so on and so forth. Then some of the documentation requirements, the master file, local file, and the CBCR. And then I'll be touching about some of the penalties. So if you do not comply with the documentation requirements, what could be the penalties you could expect? Then some of the dispute resolution mechanisms, the safe harbor rules, and finally the red flags. So as you know, in India, there is a lot of transfer pricing litigation. So over here, we'll see what exactly are the areas in which you would have much of the litigation, and the tax officers could say put a red flag. So with respect to the TP regularities, as you know, for any transfer pricing rule to apply, you should have, say, say a transaction between two associated enterprise. So which is called an international transaction, but in an Indian scenario, you have something called as a deemed international transaction. And now what exactly is a deemed international transaction? It is a transaction between two enterprises which are not associated enterprises. So basically two companies which are absolutely not related to each other. Even to them, you would have the transfer pricing rules which would be applicable when, if there is a prior agreement in relation to the relevant transaction between such other person and the associated enterprise, or the terms of the relevant transaction are determined in substance between such other person and the associate enterprise. So this is basically a unique feature of the Indian transfer pricing regulations, where you have two companies, say one company which is located in India and one company which is located in a foreign jurisdiction, which are absolutely not related. To them also, you could have the transfer pricing regulations which could be applicable. And over here, I've just quickly given a brief graphic representation under what situations you would have the transfer pricing rules which would be applicable. So if you see the first scenario where we see, which is a company B Ltd, which is located in India, it is the 100% subsidiary of a company located outside India, which is A Inc. So A and B are related entities, but over here, the transaction is between B and C. C is not an entity which is part of the group, but if there is a sale of goods between C to B, but in substance, the terms of the supply of C to B is determined by A and B. In that case, you would have transfer pricing regulations which could be applicable. And then the second scenario where we have two companies which are located in India. So this is a unique scenario where you have both the companies which are located in India, and then you have Z Inc., which is a 100% subsidiary again of X Ltd. There is again a supply contract between X and Y, which are not related companies. But in essence, the terms of the supply are decided by Y and Z. In this situation, you would have the transfer pricing regulations, which could be applicable even in the domestic scenario. So the so the concept of deemed international transaction is a pretty unique, and then you have to really be careful that even if you're dealing with a third party, whether you are satisfying the conditions of deemed international transaction, because what used to happen is that like many of the companies, to circumvent the transfer pricing provisions, they used to have a third party within the transaction. So if you have a third party, then ideally you wouldn't have the transfer pricing regulations which would be applicable in a particular case. So to plug this loophole, the Indian government came up with this provision of deemed international transaction. Now going back, the second is the use of multiple year data. Now in India, we have the use of the multiple year data. So basically the data from the current year as well as from 2 preceding years is to be taken into consideration when you are using, say, RPM, CPM, or a TNMM as the most appropriate transfer pricing methods. In the case where you don't have the current year data which is available, then you can use only the 2 previous years data in this particular case. But however, if you have an audit going on and during the audit you have the current year data which becomes available suddenly, then the taxpayer as well as the tax administration can make use of this particular data. And then going to the range, in India we have this unique say principle of the arithmetic mean. So if you have less than 6 comparables, then the arm's length price should be the arithmetic mean. And like obviously there is also a tolerance range of 1 to 3%. But if you have 6 or more comparables, then you have the range starting from the 35th to the 65th percentile, when the data set is located in the ascending order. So this is with respect to the range. And we have the range which is only applicable to the first 4 methods. So for CUP, TNMM, RPM, and the cost plus method. Obviously for the profit split method, this is not really applicable. Now going to the documentation requirements quickly, this slide is pretty self-explanatory, but India has adopted the 3-tier documentation requirement as mandated by BEPS Action Plan 13 of the local file, the master file, and the country by country reporting. And then as like mentioned by Natalie and Marcelo, the local file is something which is more detailed, and you have much of the information with respect to that specific entity and the transactions which are mentioned in detail. Over here, we have that the local file requirement is to be satisfied if the international transaction exceeds INR 10 million. So over here, I have just given a rough calculation of like INR to Euro, say the conversion. So if you have, say, a transaction which is international transaction, the aggregate transaction exceeds more than 10 million, then you have the requirement of the local file which needs to be satisfied. And even if you're not satisfying the requirement of 10 million threshold, it is prudent to have the local file maintained, because the tax administration asks you for it, whether you have complied with the arm's length principle or no. So even if you're not fulfilling the threshold of 10 million, it is advisable to have the local file requirements in place. And apart from the local file, India has something called as an accountant's report. Accountant report is to be filed by all the taxpayers which have international transactions, so there is no threshold at all. And it has to be e-filed irrespective of the relevant threshold. And the accountant's report is basically contains whether the international transactions which are maintained in the documentation, they are true and correct to the knowledge of the taxpayer. Now going to the master file requirements, the master file requirement, it basically consists of 2 parts. If you see Form 3CEAA, it consists of Part A, which contains the basic information of the group, like including the constituent entity which is located in India. So over here, you just have to give the basic, say the information, which is the name of the taxpayer, the tax ID, address, so on and so forth. And this requirement of Form 3CAA Part A is to be satisfied by all the taxpayer having say any international transaction or which are part of an international group. Now with respect to Part B, which is the core master file requirement, the threshold over here is 5 billion INR, and the aggregate value of the transaction should exceed 500 million INR, or if you have intangibles which are in place, then it should exceed 100 million INR. So basically both the criteria of 5 billion as well as 500 million or 100 million, depending whether intangibles are in place or no, only then you would have the master file requirement which is to be fulfilled, especially with respect to part B. And then finally, if you have more than one constituent entity which is located in India, so if you have more than one subsidiary of the global group which is located in India, then you would have so in that case, what the group should do is that they should designate one entity, which is the constituent entity out of the many entities located in India, to satisfy the requirement of the master file. And then finally, coming to the CBCR, India just last year increased the threshold for CBCR. So till last year, it was 55 billion. Now there is the threshold of 64 billion, which is there, so which is a very welcome step. And like over in this case, the CBCR requirement is to be satisfied by the parent entity or an alternate reporting entity. And if the parent entity or the alternate reporting entity is not required to file CBCR in its own jurisdiction, then in that case, you have the constituent entity which is located in India, which should discharge this responsibility of filing the CBCR. And with respect to any of the documentation, so the Indian law provides that you have to maintain all the transfer pricing documentation for a minimum of 8 years. And this requirement comes from the corporate law in India, where the companies need to maintain these documentations for a period of 8 years. So this was, in short, the documentation requirements. Now going quickly through the penalties. So obviously it's very important to abide by the documentation requirements. And over here I have listed down just a few instances like under which you can be penalized if you do not maintain the documentation. Obviously there are more default requirements which are maintained or which are part of the Indian Income Tax Act or the Corporate Act. But these are some of the few ones which are very relevant to the transfer pricing. So if you have the underreporting of income, then you have 50% of the amount of tax which is payable. And over and above, you have the penalty of 200% of amount of tax which is payable. So which indeed is a very high amount if you have an international transaction which is of a very high threshold. And secondly, if you do fail to maintain any of the documentation, then you have to pay 2% of the value of the international transaction. So again, if you have an international transactions which go to very high amounts, then 2% of that amount can be pretty high. And then if you do fail to furnish the accountant report, then the quantum is INR 100,000 rupees. And as seen before, the accountant's report is to be submitted by all the taxpayers which have an international transactions. So it is very important to keep this in mind that you shouldn't fail to furnish the accountant's report. And over and above these penalties, we also have some of the specific penalties with respect to if you do not furnish the master file or the CBCR. So if you do not furnish the master file, then you have a penalty of 500,000 INR. And if you do not furnish the CBCR report, then you have 5,000 per day up to 1 month. So if you do not submit it even after 1 month, then beyond 1 month, it is 15,000 INR up to further 1 month. And then if you do not submit it even after an intimation, then you have the penalty of 50,000 INR. So these are pretty much the penalty requirements or the penalties which you should keep in mind with respect to the filing documentation. And if you do say have an incorrect or a false information in CBCR, then you have 500,000 penalty with respect to each false information. And now quickly going through the dispute resolution mechanism. As you all know, in India, there is a lot of transfer pricing matters which are pending in court, and the tax administration is very aggressive when it comes to the adjustments and when it comes to taxing these international transactions, and they usually many a times come up with ingenious arguments to have a transaction within the framework of these penalties and these requirements. So this is the dispute resolution mechanism which is in place. So the first we have the level of DRP or the CIT appeals. So DRP is the dispute resolution panel and CIT is the Commissioner of Income Tax Appeals. This is basically the first level of appeal. So if you have an assessment order by the assessing officer, then you basically have two options. You can either go to the DRP, which is the quicker route where the DRP is supposed to file is supposed to have the order ready within the period of 9 months. Or the second option is to go to the CIT appeals. Over here, you don't have a time limit, but usually it is required for the CIT appeals to have a decision within 1 year, but many of the times it goes much beyond 1 year. And then you have the second level of appeal, which is the ITAT. This is Income Tax Appellate Tribunal. And over here, if you go through the DRP route, then the taxpayer have an option to file an appeal against the order of the AO. So after DRP, the final order which is passed is usually by the assessing officer. And then in this scenario, you only have the taxpayer which has the option to appeal to the ITAT. But if you go through the regular route of the CIT, then you have the taxpayer and the tax administration both which have an option to file the appeal in this particular scenario. And it is very important to keep in mind that ITAT is the last court in which you can litigate with respect to an issue of fact. So if you have any fact or any discrepancy with respect to fact which you have to litigate, that it can be only done till the level of ITAT, because if you go further, High Court, then in High Court, you can only litigate with respect to a question of law and not with respect to a question of fact. And over here, again, you have the taxpayer and the tax administration can both file an appeal with respect to an order of ITAT. And then finally is the Supreme Court, which is the ultimate court of the land. And over here, again, you can only litigate with respect to the question of law. And if you see the dispute resolution mechanism in India, I mean, most of the time, even if the tax administration, it makes some kind of adjustments or it gets very aggressive with respect to a particular transfer pricing matter. But if you do go to the court, then most of the time you would have really good decisions which are laid down by the courts in India. But the problem is that this litigation right from CIT to the Supreme Court, it takes a really long time. So if you have even the ITAT, which is the second level of appeal, over here, it can take up to 2 to 4 years, and even in High Court, 2 to 5 years from the date of filing. And then quickly going through the safe harbor rules. So India did introduce the safe harbor rules in 2009. And these are some of the safe harbors which are there on the screen. So first we have safe harbors with respect to the IT services, which goes from say 17% to 24% of markup over operating costs. So if you have say like a provision with respect to software development and information technology enabled services, and where the threshold of international transaction is up to it's up to 10 million like INR, then you have 17% markup over operating costs. And if it is above say 10 million, then you have, if it is above 1 billion, then you have say 18%. Again, if these services are with respect to knowledge process outsourcing services, then it is 18% up to 2 billion. And again, beyond 2 billion, it is 24%. So with respect to IT services, you really have to see which are the specific IT services and what are the thresholds. And then you have the operating margins can differentiate between 7 to 24%. Again, we have the pharmaceutical, we have safe harbors with respect to the pharma sector. Over here, with respect to the provision of contract R&D, of generic drugs. If the threshold is 2 billion, you have markup of 24% over operating costs. Again, with respect to automobile, manufacture and export of core automobile components can go up to 12%. If it is non-core, it is 8.5%. And with respect to low value adding services, it is 5% markup on total cost. Like in this situation, the total threshold should not exceed, with respect to the markup as well, should not exceed 100 million INR. And then there are also some specific safe harbor rules with respect to the financial transactions, but those safe harbor rules are pretty much detailed, which do not form part of the slide. But basically, if you have also a corporate guarantee, then a safe harbor would be 1% of the total loan, which is borrowed by the subsidiary. And now quickly going through the red flags. I know we are beyond time over here. The first, so these are some of the issues which are very contentious in India. And the problem is that with respect to many of these issues, there is no decision by the Supreme Court. So there are, say, appeals which are pending in the Supreme Court, but the Supreme Court still hasn't come out with a decision yet. The first and the foremost contentious issue is with respect to marketing intangibles, and specifically with respect to the AMP expenses, which is the advertising, marketing, and promotion expenses. So over here, what the tax administration does is that it says that the AMP expenses, which are incurred by the local entity, is for building the brand, which is the global brand. And hence, the local entity is in effect the economic owner of the intangible and should be compensated with respect to the residual profits. And what they do is they use something called as a bright line test. So they see basically, say, comparative distributors or comparative companies within the local jurisdiction and how much they would spend regularly with respect to these marketing functions. And if the company forms its marketing expenses, which is over and above this bright line test, then it makes an adjustment and it says that those expenses should not be taken into account, and the foreign entity should actually compensate the Indian counterpart with respect to these expenses. But there are many court decisions in India which does not agree to the stand taken by the tax administration, but these matters are still pending in the Supreme Court, and we'll see what exactly the Supreme Court would say in respect of that. The second point is with respect to location saving. As you know, India is a low cost jurisdiction, and if you have say operations which are moved from high cost to low cost jurisdiction, then you could have location savings. And Indian tax authorities, they have a stand that location savings are basically intangibles, and there should be adjustment made with respect to the profits of the local entities in India. Then the third is with respect to the contract R&D. Again, the tax administration has taken a stand that these contract R&D services are basically sophisticated services, and they are high value adding services, and hence they do end up creating, say, a unique and valuable intangible for which the local entity, though it is a contract R&D entity, which should be compensated with respect to the residual profits. Fourth, profit attribution to PEs. So India does not follow the authorized OECD approach, which is the AOA, and it has sort of, with respect to the profit attribution to the PEs, sort of a formulary apportionment view, which it has taken. And the last is the intragroup loans. So though there are safe harbor rules with respect to intragroup loans, but the taxpayer should really be careful with respect to having, say, loans in foreign currencies and what exactly do you take as the benchmark. So these were some of the red flags which the taxpayer should keep in mind before investing or before, like coming to the Indian jurisdiction. And though you can have the courts in India, which are usually, which usually would side with the favor of the taxpayer if obviously the taxpayer is in the right, but you should also keep in mind that these litigation, they take years and years, and it is usually better to go through the route of either safe harbors if you do fall into one, or through the route of like APAs. And that was it from my side. Yeah,
okay.
Thank you.
Thank you very much. And Abhishek, yes, I find really interesting your last slide, the point about the location savings, which, considering the Indian environment, I think is one of the most important topics. Of course, because there are a lot of M&As which decided to locate to India, of course, to receive benefit of let's say, the advantages, also intellectual advantages of India. So I think the INTP is one of the most interesting topics of absolutely the location savings. And just as last comment, I want to take a note from one of your first point in the beginning of the presentation when you were speaking about the arm's length range. I found very interesting when you say that if there are less than 6 comparables, the arm's length price should be an arithmetic mean. Instead, if it's 6 or more comparables, the range is starting from the 35 to 65% percentile. Starting from these bullet points, I would like your final comment about how is developing the TP policy of your jurisdiction on the application of the APL. So I understood that Italy, maybe Germany and India, they have different way to approach the application of the APL. Italy, we know, delivered last week the circular letter, very important about the application of the APL. But I would like your final comment, just 1 minute each, to close this conversation. What's your feeling? In which direction is developing the application of this principle in your jurisdiction? Yeah, we can start from India, and after we go back, we finish to Italy. So Abhishek, if you want to start with 1 comment. Wait. Okay.
Yeah, thank you for that. Yeah. So as mentioned, India has been following really the arm's length principle since the time the Indian transfer pricing rules were taken into place. And what exactly which you mentioned with respect to say the arithmetic mean and with respect to the range. Now, till a few years ago, the Indian transfer pricing regulation said that if you have more than 9 comparables only, then you can use the range. Otherwise, you have to use the arithmetic mean. And I think this feature of the Indian transfer pricing regulation, it is very unique, because you don't have like either in the OECD guidelines or in any country practices have something called as an arithmetic mean so much in practice. So I think this is one of the deviation from the OECD guidelines. And I would say the second deviation would be with respect to foreign comparables. So the Indian transfer pricing rules doesn't really make a distinction between local comparables and foreign comparables, but then you have situations where the transfer pricing officer specifies that you need to have local comparables mostly in your database. And with respect to the other issues of say arm's length principle, India follows a strict arm's length principle policy since the inception. And though there are a few deviations, but I think we try to stick as far as possible to the arm's length principles which are enshrined in the OECD guidelines. And even when you go to the court, the OECD guidelines, they do have a lot of persuasive values while convincing a court of law with respect to a particular transfer pricing say case.
Okay, great. Marcelo, do you have any thought about let's say Germany? Because of course Brazil is related. Wait, I think probably you have. Okay, you should be able to.
Yeah, now I can speak. Yeah, I think for the call, you are the one controlling that. So yeah, I think Germany really follows since the beginning the OECD, the arm's length principle, and it also contributes within the within the work of the OECD actively, and it's reflected really extensively in the German tax legislation. For instance, they just was implemented just recently the DAMP functions within tax law, within the law in general. I would just see whether there is sort of going out of arm's length principle. Red flag would be the financial transactions, which I meant in my slides. So it's still open, although the German tax administration has updated its guidelines, its principles regarding the financial transactions more aligned to Chapter 10, but it's still in practice, in the concrete case, quite open or not or uncertain how they will value it, and for most importantly, how they are going to value the implicit support within the company. So that's a red flag to be pointed out and to be watched out closely in the next years.
Okay, great. And Natalie, just was last comment of the day. Okay. I think you should be able to.
Yeah,
okay.
no, yes. Okay. Okay, yes, thank you. And actually, yes, also Italy regarding the arm's length range, as mentioned, seems to follow now the OECD standard. The last circular letter seems to explain how to apply it, and the Italian tax authorities used to actually apply the interquartile range as a result of the comparability analysis, as a result of the application of the PLI to the comparables identified. With the last circular letter, it seems now to open, as the OECD mentioned and provides, to open to the full range of results. Thus, if the PLI applied by the taxpayer falls within the range of the arm's length range identified, we should be able to apply the full range. I mean, any value within the range can be deemed compliant with the arm's length principle. On the other side, if the taxpayer or the tax authority finds out that actually a PLI falls outside the range, then we should consider a more narrow range, thus that resulting with the use of the application of some statistical tools. And I found it interesting how, for example, India applies this narrow range, ranging indeed from the 35th percentile to the 65th percentile. Instead, in Italy, we used to consider the narrow range between the lower quartile and the upper quartile, that's between the 25th and the 17th percentile. Then we'll see, actually, in my opinion, this is a good point, a good way to align the Italian standards to the OECD guidelines, and thus to help also the discussion with foreign jurisdictions in case of tax audits with also foreign jurisdictions. However, we may also consider, and we will see how this will be actually applied in practice, and how this will be considered during the tax audits. As mentioned also by Marcelo, also in Germany, tax authorities are looking deeply to transfer pricing issues, intercompany transactions, and the documentation burden is really high. And there are some focus also with respect to financial transactions. Also in Italy, this will arrive, I'm sure, as a result of the new regulation, the new Chapter 10. Thus, we'll see, actually. And also the safe harbors. It's good to understand how comparatively this will be applied, actually.
Yeah. Absolutely, I agree with you. So I think it's time to close. We are 15 minutes late, super late. I want to just thank you all. Thank you, Natalie. Thank you, Marcelo. Thank you, Abhishek, and of course the Transfer Pricing Center of Vienna. And this was absolutely a really interesting conversation with you to understand which are the comparison between the TP policy around the world and which are the difficulties that Italian entities, but of course also foreign entities, are going to face in the process of internalization in India, in Germany, in Brazil, in India, in one of our jurisdictions. And we know that there are different peculiarities, different characteristics in each jurisdiction. The process of full compliance with the OECD probably in some cases is still very long, but let's hope there will be possibility to go back as soon as possible to speak and with a new conversation about this argument. For the moment, I would say that we can close here this webinar. Thank to of course all the speakers and to all the attendees, and looking forward to speaking with you again soon. Okay, thank you very much. Bye bye.
Thank you all. Have a good night. Bye.
Bye. Bye guys. Bye bye.